Imagine putting your crypto to work instead of letting it sit in your wallet. You deposit your tokens into a DeFi protocol, and in return, you start earning more tokens. Sounds like a digital savings account, right? Well, not exactly. Because in crypto, whenever someone tells you you can earn 50%, 100%, or even 1000% APY, there is usually another sentence hiding somewhere. And you could lose everything. Welcome to yield farming, a system that helped turn DeFi into one of the crypto's biggest experiments. Today, we're going to understand exactly what yield farming is, how it works, where the rewards come from, why people chase insane yields, and how a strategy that looks like free money can sometimes become an extremely expensive lesson. Let's start from zero. Yield farming is a DeFi strategy where users provide their crypto assets to decentralized protocols and receive rewards in return. Those assets might be supplied to a lending protocol, deposited into a liquidity pool, or used in another type of decentralized financial application. The basic idea is simple. Instead of keeping your crypto idle, you put it to work. Think of it like renting out your capital. You provide liquidity or capital to a protocol, other users interact with that system, and you receive some form of compensation. But unlike a traditional bank account, there is no government-backed savings guarantee protecting you if the protocol explodes into digital confetti. Why do people call it farming? Because you're essentially putting capital into a system and trying to harvest returns. Instead of planting seeds, you deposit tokens. Instead of crops, you hope to harvest yield. And instead of rain, you pray that the smart contract doesn't get hacked. The terminology became popular during the DeFi boom around 2020, when protocols began aggressively rewarding users with tokens for providing liquidity and participating in decentralized financial applications. Suddenly, people weren't just buying crypto, they were trying to make their crypto generate more crypto. To understand yield farming, we need to go back to 2020. During what became known as DeFi summer, decentralized finance was gaining momentum and protocols started experimenting with token incentives. One of the most famous moments came with Compound, which introduced EOMP token rewards for users interacting with its lending protocol. Then came Yearn Finance, associated with Andre Cronje, which automated parts of yield optimization. Protocols began competing for liquidity. Users moved capital from one platform to another, searching for higher returns. It created a new financial game where liquidity itself became something protocols competed to attract. And for a while, it felt like everyone had discovered a money printer. Let's make this practical. Imagine Alice has ETH and USDC. She deposits both into a decentralized exchange's liquidity pool. Now Bob wants to trade ETH for USDC. Instead of trading against a traditional market maker, Bob can trade against the pool. Alice's liquidity helps make that trade possible. In exchange, Alice can receive a portion of the trading fees generated by the pool. That's one form of yield farming. The important idea is that the yield comes from activity within the system, such as trading fees or protocol incentives. It isn't magic money appearing from nowhere. A liquidity pool is basically a smart contract containing assets that users can trade against. On automated market makers, or AMMs, liquidity providers deposit token pairs such as ETH and USDC. Their liquidity allows other users to swap between those assets. In return, liquidity providers can earn a share of trading fees. The exact mechanism depends on the protocol. Some pools use different mathematical formulas, concentrated liquidity ranges, or other designs. But the basic concept is the same. You provide liquidity, traders use that liquidity, and you may earn fees. This is one of the most important questions you can ask. Where does the yield actually come from? There are several possibilities. It can come from trading fees paid by users. It can come from borrowers paying interest. It can come from protocol revenue. or it can come from newly issued tokens used as incentives. And these sources are not equally sustainable. If you're earning yield because thousands of users are paying real fees, that's very different from earning 500% APY because a protocol is printing its own token and giving it away. Before chasing a yield, understand its source. You'll often see two numbers, APR and APY. APR is generally a simple annualized rate that doesn't assume compounding. APY accounts for compounding. That means if your rewards are automatically reinvested, APY can be higher than APR. But here's the trap. A displayed APY is not necessarily what you will actually earn over an entire year. Crypto yields can change rapidly. Token prices can collapse. Liquidity can move. Incentives can end. So when you see get you 800% APY, don't imagine someone has discovered an infinite money machine. Ask what assumptions are behind that number. Now comes the obvious question. If a project offers 1000% API, who's paying for it? Sometimes the answer is simple. The protocol is distributing tokens to attract users. Imagine launching a new restaurant and telling customers, eat here and we'll give you free coupons. Everyone shows up. The restaurant becomes crowded. But if those coupons are worth less every day, the apparent reward isn't nearly as impressive. That's similar to what can happen in yield farming. A protocol may offer enormous token incentives to attract liquidity, but if everyone sells the reward token, its price can collapse. One of the most misunderstood risks in yield farming is impermanent loss. Imagine you deposit ETH and USDC into a liquidity pool. Then ETH's price suddenly doubles. The automated market maker adjusts the pool's ratio as traders buy ETH. When you withdraw, you may end up with less ETH and more USDC than you would have had by simply holding the two assets yourself. The difference is called impermanent loss, and it can become particularly painful during large price movements. You might earn trading fees while still underperforming a simple buy and hold strategy. Yield doesn't automatically mean profit. Next is smart contract risk. Yield farming relies heavily on code. If that code contains a vulnerability, attackers may exploit it. And this isn't theoretical. DeFi has experienced numerous hacks, exploits, and attacks over the years. Audits can reduce risk, but an audit is not a magical security certificate. A protocol can be audited and still contain vulnerabilities. So whenever you're depositing money into a DeFi protocol, you're not only betting on the yield, you're also trusting the code. Then there's the classic crypto nightmare, the rug pull. A project may advertise enormous yields to attract liquidity, only for insiders to exploit the system or drain funds. Sometimes the issue is malicious code. Sometimes it's centralized control. Sometimes it's simply a dishonest team. This is why a high APY isn't enough. You need to investigate who controls the protocol, how the contracts work, whether the code is verified, whether there are administrative keys, and whether the project has a track record. Here's another brutal reality. You can earn thousands of tokens and still lose money. Suppose a protocol gives you 500 reward tokens. At the time you receive them, they're worth $10 each. Congratulations, $5,000, but then everyone starts selling. The token falls to 10 cents. Your $5,000 becomes $50. The number of tokens increased, but your purchasing power didn't. This is why you should always evaluate yield in terms of the underlying asset and overall portfolio value, not simply how many tokens you're receiving. Some yield strategies involve borrowing, leverage, or leveraged positions. That adds another layer of risk, liquidation. If the value of your collateral falls below a certain threshold, the protocol may liquidate your position to repay the debt. This can turn a normal market decline into a much larger loss. Leverage can amplify returns, but it can amplify losses too. If you're a beginner, don't look at a complicated strategy and think, more steps must mean more profit. Sometimes more steps simply mean more ways to get wrecked. One of the biggest myths around yield farming is that it's basically free money. It isn't. Yield represents compensation for taking some kind of risk or providing some kind of service. If the return looks dramatically higher than everything else in the market, there's usually a reason. Maybe the token is highly volatile. Maybe the protocol is new. Maybe liquidity is thin. Maybe the rewards are temporary. Maybe the smart contract risk is enormous. In finance, high returns usually come with high risks. Crypto didn't repeal that rule. It just put it on a blockchain. Despite the risks, yield farming played a major role in the growth of DeFi. It gave users incentives to provide liquidity. It helped bootstrap new protocols. It encouraged experimentation with decentralized exchanges, lending markets, and governance tokens. The concept also changed how crypto users thought about their assets. Instead of simply asking, "Will Bitcoin go up?" people started asking, "What can my assets do?" That shift helped create an entire financial ecosystem built around programmable money. Before putting money into any yield strategy, ask a few questions. Where does the yield come from? Is it trading fees, lending interest, protocol revenue, or newly issued tokens? What is the token supply? Can rewards be dumped on the market? How much liquidity does the protocol have? Who controls the contracts? Are there admin keys? Has the code been audited? How long has the protocol existed? What happens if the token drops 80%? And perhaps the most important question, would I still want this asset if the yield disappeared tomorrow? If the answer is no, you may be chasing the yield rather than investing in the underlying asset. Beginners often make the same mistakes. They chase the highest APY. They ignore token inflation. They don't understand impermanent loss. They deposit everything into one protocol. They use leverage they don't understand. They assume audits guarantee safety. And sometimes they follow a random influencer who says, "Bro, this farm is printing." If your investment thesis can be summarized as the APY is huge, you probably haven't finished your research. So is yield farming dead? No. But the industry has matured. The wild 10,000% APYs that attracted attention during the early DeFi boom were often unsustainable. Today, sophisticated DeFi strategies can involve liquidity provision, lending, market making, staking, restaking, and automated vaults. The terminology can overlap, and the exact mechanics vary by protocol. What hasn't changed is the fundamental principle. You're earning a return because you're taking risk or providing capital to an economic system. The future could make yield strategies even more automated. Smart contracts can already automate many financial processes, and AI agents could potentially monitor opportunities, compare rates, and manage predefined strategies. Tokenized real-world assets could also introduce new sources of on-chain yield. But automation doesn't eliminate risk. In fact, it can sometimes make mistakes happen faster. The future of DeFi isn't simply about finding the highest yield, it's about finding sustainable yield with transparent risks. Here's the lesson I want you to remember. Don't ask only, "How much can I earn?" Ask, "Why am I being paid?" If you can't explain where the yield comes from, you don't understand the investment. If you don't understand the smart contract, you don't understand the risk. And if you can't survive the possibility of losing your capital, the yield isn't worth chasing. In DeFi, the percentage displayed on the screen is only half the story. The other half is the risk hiding behind it. Yield farming represents one of crypto's most interesting ideas. Your digital assets can potentially become productive capital, but productive doesn't mean risk-free. You can earn trading fees and suffer impermanent loss. You can receive rewards while the token collapses. You can find a high-yield protocol and discover a smart contract vulnerability. You can chase the biggest APY and end up with the smallest portfolio. So don't farm blindly. Understand the protocol. Understand the yield. Understand the risks. Because in crypto, the highest number on the screen isn't always the best opportunity. Sometimes it's just the biggest warning sign. If you enjoyed this video, like, subscribe, and join Blockwise for more deep dives into crypto, Web3, finance, and the technology shaping the future.